The US didn't just impose new tariffs on Canadian goods. They've been escalating all throughout 2025. And even if we do get a resolution in July, more could be coming. Because tariffs, they're not new. The US has been placing tariffs on Canadian softwood lumber and agriculture for years. You might think that's about lumber and steel, that's business stuff. But here's what nobody's talking about. And if you own a home or you plan to, you should pay close attention. Because tariffs, they can not only impact your mortgage rate, but your home value as well. Let me explain. Let's rewind back to 2018 during Trump's first term in office.
One thing I have to do is economically take on China, because China has been ripping us off for many years. Somebody had to do it. I am the chosen one.
During that time, his administration started a trade war with China. But also, they imposed steep tariffs on Canadian softwood lumber, as well as steel and aluminum. So what happened? We watched the bond yield surge, the Bank of Canada had to pause cutting interest rates, and we watched fixed interest rates in Canada rise by 40 to 70 basis points in just 60 days. That means your average 5-year fixed rate went from 2.95 all the way up to 3.59%. And for the average Canadian taking a mortgage during that point in time meant an increase in your monthly payment of $200. Let's fast forward to today. In Canada, we've been in a trade war with the United States for the majority of 2025. They've re-upped their stance on Canadian softwood lumber, steel, and aluminum. And while there's hopes for a resolution by the end of July, history tells us that these pressures aren't going away. And tariffs, they're inflationary. And inflation equals higher bond yields, which brings us to this. Think of government bonds like Canada's credit card. Investors or Canadians, when they choose to buy the government bond, are basically lending money to the Canadian government. The interest rate that they are going to receive from the government for lending that money is what we call the yield. Now here's the key. Fixed mortgage rates in Canada are directly tied to these bond yields. When the bond yields go up, we watch the fixed rates go up. And when the bond yields go down, we watch the fixed rates come down. Tariffs, global tension, and inflationary pressures all push the bond yields higher. So even if we're in a position where the Bank of Canada is potentially cutting the overnight rate, we could still see fixed rates rise. That's what we saw in 2018, and we're starting to see it unfold again here in 2025. And this matters now more than ever, because 70% of Canadians are expected to renew their mortgage between 2025 and 2026. This is the biggest mortgage reset that we have ever had in Canadian history. So if you're part of that group, you could see bond yields spike. Even with inflation under control, the global and political uncertainty that's currently at play doesn't mean that you're safe. Let me give you an example. In 2021, you bought a home in Kelowna, 20% down, $700,000 home, 5-year fixed at a fantastic rate of 1.79%. Your monthly payment, $2,315. Now, in 2025, you're up for your renewal. Your mortgage balance is almost $100,000 lower than when you started, but due to rising bond yields from ongoing tariffs, your best rate is 4.3%. Your new payment, $2,895. That's a $580 a month increase on a smaller mortgage than you originally had. And it's all because of US trade policy. So what do you do with all this information? Because you can't control the US tariffs, and you're not going to call up Jerome Powell in the bond market and tell him to chill out while you plan your next real estate transaction. But you can choose how you respond depending upon where you're at. Let me break it down. You're probably already stressed. Every single headline that you read seems like another reason not to buy. But here's the thing. You don't have to nail the timing with the real estate market. What you have to do is make an informed decision that doesn't paint you into a corner in the future. So if you're buying in this market, there are 3 key things that you should consider. The first is make sure that you stay underneath your budget. Even though you're pre-approved for $750,000, doesn't mean that you have to buy for $750,000. It will keep your cash flow position strong and allow you more flexibility to upgrade later. Second, Make sure you choose the appropriate mortgage term for your risk tolerance and your needs. Having the wrong mortgage term can paint you into a corner and limit your options to pivot should you need to do so. Third, and probably most important, is let go of that forever home mentality. Your first purchase in the real estate market doesn't have to be your forever home. It's a stepping stone in order to get you into your dream home in the future, and buying and staying conservative now will protect your upgrade options later. This is where most people get blindsided. You've been cruising along at a fantastic rate of 2.59% for the last 5 years. Your mortgage renewal is coming up, and bam, interest rates are now in the 4.3% range. It doesn't take much in terms of our political and economic environment to see the bond yields rise and interest rates very quickly get back up over 5%. So here's what you should do if you have your mortgage renewal coming up this year. First and foremost, start early. Majority of clients can early renew their mortgage with their existing lender inside of 6 months. That might be a little bit early, but rates can definitely be held for at least 120 days out from when your potential mortgage renewal is. Your bank, they're only going to hold that rate that they're offering you for 14 days. So make sure that you're shopping your options. This is the next biggest factor when we're renewing our mortgage. Mortgage banks today know that there are 70% of all Canadians renewing their mortgage. They're incredibly competitive. You want to make sure that you're getting the best pricing. Our bank is going to offer us a very competitive rate, but not without you pushing them first to do it. They want you to pay as high an interest as possible, and it's our job to make sure that you're not going to do that. Make sure that you're inquiring and giving yourself enough time to manage that renewal so that you get the best deal moving forward. A mortgage refinance may be the most underestimated tool in a Canadian homeowner's tool belt. Let's assume that you have some high interest credit card debt at 19%. You also have a car loan over here costing you $1,200 a month. On top of that, you got a line of credit that you've racked up that's now at 8%. We can take all of that debt and we can roll it into the mortgage. On top of that, we can take your existing amortization and push it back out so that you have a much better cash flow position on a monthly basis. We certainly do not want to be using our home as a piggy bank, and this is not something that you want to do over and over again. But if you've been in a tough position, this could help you get ahead in the next 3 to 5 years. What we're able to do is then take that additional capital that you've been putting towards those car payments, lines of credit, and credit cards, and repurpose that into paying down the mortgage at a much more rapid rate. Whether there are tariffs or no tariffs, this is a smart way to stop leaking money into high interest debt and start getting ahead in the next 3 to 5 years. Every single one of these moves has a timing window. And when bond yields spike, that window, it closes fast. You don't have to panic, but you do need to start to plan. I'm Tyler Wilson from Pilot Mortgage Group. We run these numbers daily so that you don't have to. Let's run your numbers, take a look at your options so that you can make the smart play moving forward.